HELOC versus home equity loan. When you need extra cash, whether it's to remodel your kitchen, consolidate high-interest debt, or cover a big expense, two of the most common ways to tap into your home's equity are a HELOC or a home equity loan. They sound similar, but they work in very different ways. Let's break them down in detail so you can see which one fits your plans. What is a home equity loan? A home equity loan is like a second mortgage. You get a lump sum, say $50,000, then pay it back over 5 to 30 years at a fixed rate. Payments never change, which makes it great for budgeting. It's best for one time, big expenses like a remodel, tuition, or paying off high-interest debt. What is a HELOC? A HELOC, or home equity line of credit, works more like a credit card tied to your house. You're approved for a line, maybe $50,000, but you only borrow what you need during a 10-year draw period. Payments can be interest-only at first, but rates are usually variable, so they can rise or fall. How to decide? Think about how and when you plan to use the funds. Choose a home equity loan if you want stability and a set payoff date. It's smart for a $100,000 kitchen remodel, add a new roof, or paying off high-rate credit cards in one sweep. Choose a HELOC if you want flexibility. Real estate investors often use it for multiple renovations. Interest rates and tax perks. Home equity loans usually start with a slightly higher fixed rate than the introductory variable rate of a HELOC. But with a HELOC, rates can climb as the market moves, something to keep an eye on if interest rates rise. Now, about taxes. The IRS allows you to deduct interest on either loan only if the money is used to buy, build, or substantially improve your home. Both loans show up on your credit report, but they affect your score a little differently. HELOC, because it's revolving credit, it impacts your credit utilization ratio. Large draws can temporarily lower your score until you pay them down. Home equity loan, treated like an installment loan. Your score may dip briefly when you open it, but steady, on-time payments can actually help build a strong payment history over time. And of course, lenders will look closely at your credit before approval. The higher your score, the better your rate. So always check your report and correct any errors before you apply. Other factors to weigh. Fees and closing costs. Both typically cost less to set up than refinancing your entire first mortgage, but you'll still see appraisal fees, title charges, and recording fees. Loan-to-value ratio. Most lenders let you borrow up to 80 to 85% of your home's appraised value, minus your existing mortgage balance. Repayment discipline. With a HELOC, making only interest-only payments can leave you with a big balance once the draw period ends. Be sure you're ready for the switch to full repayment. If you crave certainty and a guaranteed payoff date, a home equity loan gives you peace of mind. If you want flexible access to cash for projects that come in waves, a HELOC might be the smarter move. Either way, remember, your house is the collateral. Missing payments puts your home at risk. So borrow responsibly and match the loan to your goals, your budget, and your comfort with risk. Whether you're moving in 9 days or 90, call me. I'm here to help you buy or sell a home, get the right mortgage, or fund your next flip or construction project. Click the link in the description to schedule a Zoom call with me today, and let's make it happen.